I'm Runjhun Jain, Senior Research Analyst at Nirmal Bang. Today I would be covering a topic, how to read an annual report. Annual report is a Bible of the company. It is the first step for any investor to start looking for a company, to start understanding the industry. It is the first step they should do it. So what is an annual report? An annual report is the annual communication, as suggested by the name, to all its stakeholders. Stakeholders can be debt holders, bankers, equity holders, anyone. So it is the most important and most authentic report from a management side to a stakeholder explaining about the industry, business and the financials. It can be from 80 to 300 pages kind of a report, which can put off some of the investors going through them, seeing the size of the report. So that is why we need to focus what is important in an annual report and how can you sail through it. For this, I would suggest that you should go with 80-20 rule. The 80-20 rule suggests that 80% of the report you can just glance through it, but the 20% of the information in the annual report is most important, where you need to focus and you need to pay more attention. So there are the basic 3 or 4 points which you need to look in an annual report. The first would be the chairman's letter. In the chairman's letter, there could be the chairman can explain about the industry. He can explain you in very brief about the business and give the outlook. This is very important to understand and to get an overview of the industry and the business. The second point is management discussion and analysis. That is the most important parameter aspect of an annual report. This is the point where you need to spend most of your time to. It can be further divided into industry, business, segment performance, risk and outlook. Industry component would explain you how the industry is going, what are the factors, macro factors which is affecting the industry of that company. For this, to get a more holistic view, I would suggest that you should look the peers annual report also to give a brief about the industry, because it can be little subjective from company to company. Second is the business performance in MDA. The management discussion analysis can be said as MDA. So business performance would tell you the segments the company is into. It could be only one, like a Lupin is only involved in pharma, but a company like SRF Limited has many segments, and all the segments has different dynamics. To understand it better, you need to understand and go through the whole business segments. The third component is the risk involved in the business, and the fourth is the forward looking outlook the company can give, that how they see that the future can look. It can be macro or micro, related to both. The next point we see is financials, which is also very important. In financials, you would see P&L account, balance sheet and cash flow. P&L would give you an overview about the profitability of the company for the year, which is normally 12 months. The balance sheet would give you as on date of the company's assets and liabilities, and would show you how the company's liquidity and solvency position is. The last, and I would say the most important aspect in the financial analysis, is cash flow. This is the clear and most valuable component in the business is the cash, because as we all know, cash is the king. So the company can inflate their sales and inflate their profits by doing credit sales, like increasing the sales as against the debtors. But at the end, what it earns is cash, and that would decide the liquidity of the company. So I would suggest that cash flow is most important and should be focused on. The other points, which are little small points but give you very much information about the companies, could be auditors. That is just the name of the auditor. Normally, the better the auditor, like Big Four, can give you some authenticity about the company. But that can't be just one yardstick you should only look. Like we have seen in the example of IL&FS case, where the auditors were Deloitte, but that also couldn't stop the fiasco, and they were actually involved with the company management. The second point is the management salary is one point which we can see. That should be as per the industry trend and in sync with the company's profit. if the management salary is too high or has been increased in a specific year too steeply, that just shows that the management probably is taking out the money for themselves and not doing justice to the other stakeholders of the company. The third point, which is very important, is related party transactions. This is where the company would disclose that how they are doing business with their related parties like subsidiaries or any sister concerns or any promoter related company. This is, we have seen that in the Sun Pharma case, that the company was doing the domestic sales only with their own related party company called Aditya Medisales. This has put a question mark on the corporate governance of the company. The company should follow the arm's length formula to do any business, but the related party transaction should be at the company, at the industry level parameter, and not should be beneficial for any particular subsidiary or the party related to promoters. The third point you should look is the shareholding structure. It can be further subdivided like subsidiary holding, which we can see in this, which would tell you that what is the percentage of the company's holding in their subsidiaries. This would also help you understand if there is a subsidiary which is probably 100% hold or less than 100% hold and not listed, but they would be doing mostly business from that in the related transactions. For example, most of the MNC companies in pharma have their own unlisted companies which are engaged in the same business, and most of the business they are doing from that. So that just shows that the company is doing business from there and not going through the listed subsidiary can create a problem because it creates a conflict of interest. The second point is pledging of shares. This is where the promoter holding is one thing we need to see. More than 50% or the majority shows that the promoter is hopeful about the company, and there would be less chances of any hostile takeovers. The pledge of shares would tell you that the company promoters have taken loan on their personal level, against the pledge of the company's shares. This is very important aspect to see. If the pledge is very high, that can put a trouble on the stock price of the company in future. Like we have seen in the Zee Entertainment's case, where almost the 100% of the promoters holding is pledge. The last point is also important, is institution holding, which you can see under shareholding. Institution holding would show that how much the institutions like mutual funds or banks holds the percentage stake in the company. This is not the final yardstick, like if there is less percentage then the company is not doing right, is not the thing, but it can be an important factor when you are analyzing that how popular the company is. So this is all for today. I hopeful it was helpful for you. Thank you.